Welcome to the Dev Journal. The year 2026 is splitting the artificial intelligence industry in two. We are watching small, lean code bases face off against the massive, multi-billion-dollar titans of infrastructure. It is a battle between the agility of the edge and the weight of global consolidation. Today, we examine how Samsung is pushing telecommunications into the cloud at Mobile World Congress, and why Alphabet is seeing a massive 48% jump in cloud growth. It is a season of heavy capital expenditure and technical gambles that are finally starting to show their true worth today.
Sloan, I wonder if efficiency still matters when you have infinite compute. Look at NullClaw, a framework written in Zig that fits high-performance artificial intelligence into less than 700 kilobytes. I want to know if these ultra-lean, edge agents can actually disrupt the hardware dominance we are seeing.
We will find out as we track the money and the machines to see which side of this divide will define the next decade. From the trading floor to the terminal, we have the breakdown of the moves that matter right now. Our deep dive into the shifting architecture starts right now. Samsung is making a massive play at Mobile World Congress by merging their virtualized radio access network software directly with NVIDIA Grace Central Processing Units and L4 graphics processing units. This integration is not just a hardware update, but a fundamental shift in how we think about the infrastructure that powers our mobile connectivity. By using artificial intelligence, multiple input, multiple output beamforming, these systems can dynamically adjust signal patterns to squeeze much higher throughput out of existing airwaves. For mobile operators, this represents a huge win because it increases spectral efficiency without the crushing capital expense of participating in government auctions to acquire more spectrum holdings. Beyond the towers, we are seeing this technology reach deep into the enterprise edge, particularly within manufacturing plants. These facilities can now run critical operational artificial intelligence on the exact same hardware that handles their private fifth-generation networks, effectively ending the era of expensive and redundant hardware duplication across the factory floor.
Sloan, those efficiency gains depend entirely on how well these containerized radio functions actually play with others. When managed through an orchestration platform, moving from specialized, siloed hardware to cloud-native principles sounds great on a slide deck, but it introduces a layer of complexity in resource management that the telecommunications industry has rarely had to navigate. The real engineering challenge lies in the coexistence of radio and artificial intelligence workload on that shared compute pool, while the architecture allows them to share resources. I am looking for data on what happens to low-latency radio functions the moment a heavy artificial intelligence workload spikes on those Grace Central Processing Units during peak hours. Even though Samsung validated the technical feasibility using a multi-cell test environment to simulate real network conditions, laboratory results often fail to capture the chaotic interference of a dense urban environment. We need to see if these artificial intelligence-based signal processing algorithms can maintain their performance when the simulated conditions meet the messy reality. It is a classic trade-off where we are swapping dedicated silicon for the flexibility of software, defined networking and graphics processing unit acceleration. If they can solve the jitter and timing issues inherent in shared environments, it might finally turn every cell tower into a distributed data center, capable of much more than just routing calls.
While Samsung scales up the massive infrastructure of fifth-generation towers, other developers are heading in the opposite direction. We are going to pivot from the heavy infrastructure of fifth-generation towers to the opposite extreme of the engineering spectrum as we look at the rise of ultra-minimalist artificial intelligence frameworks. This shift toward extreme efficiency brings us to the NullClaw framework, a system written in the Zig programming language that achieves a compiled binary size of just 678 kilobytes, while requiring only 1 megabyte of random access memory to function effectively on constrained hardware. By reaching these tiny footprints, developers can now run sophisticated artificial intelligence orchestration on $5 hardware like the ST Microelectronics 32 or a basic Raspberry Pi, which changes the economics of edge computing by bringing intelligence to inexpensive devices that previously could not support an operating system. Beyond the hardware savings, the framework uses a modular virtual table interface patterned to allow for seamless swapping between 22 different artificial intelligence providers without needing to recompile the codebase, which provides critical business flexibility in a volatile and constantly changing artificial intelligence model market. This modular approach to memory management even includes hybrid vector and keyword searches for retrieval augmented generation without the need for external databases. And I am interested in how Vance evaluates the security and performance requirements that usually demand much more robust systems at this scale.
The cold boot time of under 2 milliseconds is what really catches my eye, especially when compared to the 10 milliseconds required by the older, Go-based NullClaw framework, because that 8 millisecond difference is the margin between a seamless user experience and a noticeable lag in responsiveness. Security on such limited hardware is often an afterthought, but here they are using CHA 20 Poly 1305 encryption on mobile central processing units to ensure that sensitive application programming interface keys are never sitting in plain text on potentially vulnerable edge hardware devices today. They have also implemented multi-layer sandboxing using Landlock and FireJolt to isolate the code executed by these agents from the rest of the system, while ensuring that these tiny agents can still interact with hardware peripherals on the board in a safe and controlled manner. We are going to pivot from the low-level efficiency of these tiny edge agents to the high-level evolution of the world's largest developer community platform as we look at the upcoming Stack Overflow 2026 update and their new Agentic search integration process.
Stack Overflow is undergoing a massive transformation by moving away from its rigid past and embracing an agentic retrieval augmented generation infrastructure. This shift on February 19, 2026, marks the official end of the single right answer restriction, finally allowing for the kind of nuanced discussion that developers actually have in real life. By removing those strict formatting guidelines, the platform is inviting contributors to share experience-based recommendations that would have been deleted years ago. This makes the entire community feel human again, providing a necessary counterweight to the flood of bot-generated noise that has started to clutter our technical search results lately. We are already seeing the impact of this cultural pivot through the latest round of community awards. 21 different members recently earned the Populist badge by providing answers that outscored the officially accepted ones by more than double, proving that the collective wisdom of the crowd is often found in those alternative perspectives. New gamification elements like the Challenge Virtuoso and Creator badges are also launching this month to reward this type of deep problem solving. It is a bold attempt to revitalize a legacy platform by treating the users like partners in a collaborative journey rather than just data points in a static knowledge base.
While those community metrics look promising, I have to wonder if the underlying engineering can actually support this new direction. The Agentic Retrieval Augmented Generation system needs to be absolutely flawless to justify making these advanced artificial intelligence assist features exclusive to the beta redesign site, while leaving the classic version of the platform behind. Even the user interface updates like pinning and renaming chats feel like basic table stakes for a modern development tool. If they want engineers to treat the artificial intelligence assist as a persistent integrated development environment companion, these features are essential requirements rather than impressive innovations that set the platform apart from competitors. Moving the source cards to the bottom of the interface is a subtle change, but it highlights the platform's struggle to balance automated answers with human attribution. They are betting heavily on this agentic infrastructure to reduce latency, but forcing users into the beta site to access it creates a significant friction point. We should keep a close eye on whether these software improvements can scale as quickly as the hardware they run on. We are shifting from the software tools developers use to the massive financial engines and hardware roadmaps making that software possible as we look at the 21-day outlook for NVIDIA. The sheer scale of capital being funneled into artificial intelligence infrastructure is shifting from a speculative trend into a fundamental restructuring of global finance. We are witnessing a level of hardware investment that dwarfs previous technological cycles, with one company effectively acting as the central bank for this entire new silicon economy. That dominance is reflected in the record-breaking first-quarter revenue guidance of $78 billion, which comfortably cleared the $72.6 billion analysts were expecting. When a company with a $4.44 trillion market capitalization beats expectations by that much, the gravity of the entire market shifts. Despite this massive growth, the market is still pricing the stock like a cyclical hardware manufacturer rather than a monopoly. With a forward price-to-earnings ratio of only 17.07 against a 64.75% earnings growth rate, there is a clear disconnect between the valuation and the actual trajectory. However, the high beta of 2.31 indicates that this ride will not be smooth for the faint of heart. Investors are bracing for extreme volatility as we approach the General Technology Conference keynote on March 16th, where any deviation from the roadmap could trigger a massive correction across the entire sector.
Those volatility metrics are certainly a warning sign for traders, but the underlying business health tells a far more stable story for the long term. Achieving 75% gross margins on physical hardware at this massive scale is practically unheard of, demonstrating an unprecedented level of pricing power in the global supply chain. This dominance allows them to generate $96.68 billion in free cash flow, creating an unassailable war chest for research and development. This capital provides a significant buffer that keeps their innovation cycle moving faster than any competitor could hope to match, regardless of the short-term price swings we might see. The upcoming General Technology Conference represents the next major catalyst, where the world expects to see the official roadmap for the Vera Rubin architecture. If they can maintain this pace of innovation, they will effectively lock in their position as the primary provider of the engines driving the next decade of technical progress. We now move from the chip designer to the cloud giant spending hundreds of billions to buy those very chips. Alphabet is currently showing oversold technical indicators and 48% cloud growth, suggesting there might be significant upside despite the risks associated with their massive capital expenditure and margin pressures. Google Cloud is no longer just a distant third in the market, as revenue has surged 48% year over year. This growth is underpinned by a massive $240 billion backlog of committed enterprise contracts, proving that the demand for artificial intelligence integration is translating into long-term revenue stability. This massive scale is evident in their consumer products as well, with the Gemini artificial intelligence models now reaching 750 million monthly active users. This sheer volume of engagement creates a powerful feedback loop for their development teams, allowing them to refine their models at a pace that few others can match. Looking past their internal operations, the market seems to be overlooking their substantial 14% stake in Anthropic and a 7.4% ownership of SpaceX. These represent massive hidden assets that provide a significant valuation cushion, as both of those entities approach potential initial public offerings in 2026. Vance, looking at the sheer scale of the balance sheet, does the capital required to maintain this lead start to outweigh the strategic benefits of these diversified investments? It seems like a lot of cash to burn just to stay at the front of the pack while navigating these complex regulatory and hardware costs.
The financial strain is becoming impossible to ignore when you consider that they are planning a massive capital expenditure ramp between $140 billion and $185 billion for 2026. That is an astronomical amount of money to sink into hardware and infrastructure in a single calendar year. This aggressive spending profile has clearly unnerved some institutional heavyweights, with firms like 3G Capital and Eagle Capital choosing to trim their stakes due to concerns over margin compression. While the company maintains a high net margin of 32.81%, that aggressive reinvestment creates significant short-term pressure. Even with those margin concerns, the technical indicators show the stock is currently oversold, with a 14-day relative strength index of 34.51. This creates a fascinating disconnect because their earnings actually increased 32% year-over-year, suggesting that the current market price might not reflect the underlying fundamentals. The broader narrative shifts from the digital infrastructure of the cloud to the physical power infrastructure required to keep the servers running. The energy demands of these data centers are driving massive interest in utility providers, as evidenced by the recent $33.4 billion Consortium buyout announcement for the AES Corporation. That $33.4 billion buyout for the AES Corporation is a massive undertaking for BlackRock, GIP, and EQT. While the headline number is huge, the underlying financials suggest this consortium is taking on a project that is riddled with operational inefficiencies and massive liabilities that could take years to resolve. The most glaring issue is the debt load of $29.02 billion, which leaves them with a debt-to-equity ratio of 7.96. When you combine that with a negative free cash flow of $4.64 billion, you realize the buyers are basically purchasing a massive mountain of high-interest obligations. Adding to the uncertainty, the company recently moved its fourth quarter and full-year 2025 earnings call all the way to March 3, 2026. This delay suggests that the internal numbers are likely shifting significantly as they prepare for this transition, and it creates a vacuum of information that usually leads to high price volatility.
Vance, shifting the lens from those staggering debt figures, reveals a strategic grab for the literal current that powers the modern world. At a share price of just $14.21, the consortium saw an undervalued asset that provides the fundamental energy infrastructure necessary to fuel the next decade of heavy computational growth across the globe. The technical indicators confirm this sense of being undervalued, with a 14-day relative strength index sitting at 33.80. This oversold condition, combined with a 3.08% decline in year-over-year revenue, made AES a perfect candidate for a radical restructuring that can only happen away from public market pressure. Private ownership allows them to fix a net margin of 13.67% without the constant scrutiny of quarterly reports. By taking this utility giant off the board, BlackRock and its partners are positioning themselves as the gatekeepers of the power grid, ensuring they have the capacity to support the massive data centers we discussed. This move represents the final piece of the puzzle for the current technology landscape, where software is nothing without the physical hardware and the electricity to run it. We are seeing a complete vertical integration of the digital world, starting from the heavy copper wires of the utility sector all the way up to the edge computing frameworks.
Ultimately, the story of the market right now is this tight coupling between the power grid, the high-performance chips, and the edge frameworks that run on them. Whether it is a multi-billion-dollar utility buyout or a lean memory management system, every layer of the stack is being optimized to handle the relentless demands of our new era. Between the 678 kilobyte footprint of NullClaw and the 48% cloud growth at Alphabet, we are witnessing two opposite ends of the technical spectrum. One side demands extreme optimization for the edge, while the other is pouring billions into massive data center expansion to keep up with the global demand for compute.
Vance, those extremes highlight the fundamental tension of 2026. This divergence defines our current landscape. We are moving toward a world where intelligence is either incredibly lean, running on tiny sensors, or backed by the staggering power of the global electrical grid. The infrastructure we discussed proves the future requires both software and massive physical energy. As the boundaries of what is possible continue to shift, the real value lies in understanding how these layers interact. We appreciate you joining us for this deep dive into the architecture of tomorrow. Stay curious and keep looking at the systems beneath the surface. Thank you for listening to the Dev Journal.